Hello, scholars. My name is Joseph AGK Oji. In our lecture tonight, uh, we'll focus on 4 things. Actually, I wrote 3, but it's 4 things. There are actually 3 topics, but number 4 is just an addition, a small addition, insertion to the topics. We will look at the spot exchange rate, forward exchange rate, the factors affecting exchange rates. Now, we also look at the U.S. exceptionalism. Why is U.S. currency strong despite the country's trade deficits? So why is U.S. dollar continue to go strong despite the trade deficit of have? I'll explain that as well. So let's begin. I hope you can see my screen. Yeah, I believe you can see it. Okay. Now, let's start with the spot exchange rate. A spot exchange rate, this is the name we use to describe the exchange rate. The current price at which a person can exchange a currency for another currency. So the current price that you can exchange the US dollar for euro, for example, is the spot exchange rate for US dollar currency pair. So the exchange rate for immediate delivery for the currency exchange. So when you want to exchange, let me give you, I use a real life example. I like to use real life example to explain the the concept I'm teaching. So let's look at this exchange rate table. Look at this, you can see that $1 at this today, as I'm talking to you now, $1 can buy only 99.998600 cents of euro. That means that €1 can be exchanged for 1.001402 US dollar. So that is the spot rate. So the exchange rate currency at that particular point in time. Otherwise, you can see that 1 Indian rupee can buy only not up to 1, but 1 cent, approximately 1 cent. Hope this screen is big enough. So that means $1 can be exchanged for 79 in approximately 80 Indian rupees, and that is the current exchange rate now. That is the spot rate. Okay, so in other words, we can see the spot rate as how much you will have to pay in one currency to buy another currency at any moment in time. That's basically what it is. Now, the forward rate, on the other hand, means the price or the exchange rate of the currency at some point in the future. Those that businesses use that are involved in international transactions always prefer to have this forward rate because exchange rates change very, very fast. So how much you are changing currency is being exchanged today will be different how much it will be exchanged 90 days from today. So, and that can affect the price of raw materials or inputs. So to prevent that uncertainty, some businesses sign what they call forward contracts, so that they have a forward contract with a bank that 90 days from now, or even 1 year from now, that this is the amount, the exchange rate you give me so that I can execute my trading, day-to-day trading operations. Okay. So sometimes a business needs to do a foreign exchange transaction port at some point in the future. So I'll give an example with a British company. The British company might make a sale of its goods internationally. In this case, maybe with another European country, but will not receive payment for at least 1 year. Now, in that case, that company might so how will that British company price its products or good without knowing what the exchange rate will be 1 year from now, especially the exchange rate for US dollar? So in that case, they can go into enter into a forward contract. That forward contract will allow that business, that British business, to lock in a specific rate 1 year from now. It's a form of agreement. Now let me explain it more so that I want to make sure that you get the point here. Now, suppose this is the exchange rate now for US euro versus US dollar. This means that euro can buy $1.001402. That means euro is worth more than the dollar. Now, so this is the spot rate. Now, for forward rate, 1 year, let's say that forward 1 year, a company that produce batteries, for example, or that import battery. Now, they import the battery. Let's say the US company that import battery from, say, Japan. So the exchange rate might change, okay? Because I'm using the European currency, so I'm going to use Germany. A battery company that import a US company that import battery from Germany. Germany uses euro. Now, you can enter into a forward contract in 1 year. In 1 year, can we say 1 year? Okay. Make sure you're seeing this. Okay, good. You're seeing it. So in 1 year. So now, 1 year from now. From now. So if the euro appreciates, that will make the cost of battery to go up, and that can affect the price the US company is selling the battery in US. So when they affect the price, it can affect their bottom line. So they might say, okay, even though that the currency might change and the exchange rates, the euro might appreciate, they can enter into a forward contract with a bank, let's say Bank of America, that in 1 year from now, they will give them an exchange rate of 1.00214 for euro, euro versus dollar, 1.0012412, so that even if the euro appreciates, that dollar will buy even if the dollar buy less dollar, so that euro will buy more dollars. Let's say it appreciates and they buy more dollars. Let's say that it appreciates to, let me put it this way, 1.11 0 to this point in 1 year from now, which means that the company will buy, after exchanging the US dollar to euro, they will be buying less batteries from the German company. So but by entering into the core contract with the Bank of America to sell them to sell them the euro at this rate 1 year from now, they can still buy the same quantity they will buy. They need to buy 1 year from today. Of course, the core contract, they pay some certain fee, and for the bank, for the bank to allow them to go into that kind of contract, that means that the company is buying large quantity of batteries, so that the bank will also make money in their own side. So that is what we call forward rate. So you can see the difference between forward and spot rate. Spot rate is current price now, and forward rate is price for the currency sometime in the future. Okay. Now let's go back to our presentation. Excuse me. Now we can now look at the factors that affect exchange rate. So generally speaking, we can the factors that can, there are 4 main factors that I would say 4 main factors. There might be other factors that affect exchange rate. Okay, so for traders, currency are the unit of account for in various nation states whose exchange rate fluctuates between one another. So now, those four factors include the demand and supply relationship in two currencies that are involved. Then the relative inflation rates, relative interest rates, and trade balance. Let's look at these factors one by one. Supply and demand of currency. Now, the demand for currency is a derived demand. Economists explain derived demand as the demand for a good or service that arises as a result of the demand for another related good or service. So we demand currency for a country because we want to buy what that country produces. So because we need that thing, then we demand their currency. So the demand is derived from the goods and services that that currency can get us. That's why. So if we demand that goods and services more, then we demand the currency even more. That will cause it to appreciate. Okay. So that's basically what it is. So the demand for foreign currency derived from demand for goods and services. The demand for goods, demand for services, and the demand for the financial assets of a country. So if we demand those things, that means to pay for them, we're going to use their currency. And that means that we demand their currency, and that will cause the currency to appreciate. But if we don't demand those things that the country make, let's say the country doesn't produce much, really, then there will be less demand for what they have. If you're not going to buy what they have, you're not going to demand their currency. So the currency value, the current value of the currency will down fall. So a change in the relative demand for euro versus dollar will cause the spot exchange rate to rise. I've given so many examples. For U.S. consumers and investors demand a variety of goods and services, especially oil from OPEC countries like Saudi Arabia and so on and so forth. So to pay for those things, the oil, we have to exchange our dollar currency to their currency and pay them. So that will cause the value of the currency to appreciate. Now, they need to buy technological equipment from US, those countries, like weapons of let's say ammunitions or medical equipment, IT services. So to pay for those things that they demand from US, they have to change their money to dollar. And then that will cause the currency, US dollar, to appreciate. So that's demand and supply for that currency. Yeah. So demand based on demand and supply of what the currency can buy. Okay. Now, next one is inflation. As a general rule, a country with a consistently lower inflation rate exhibits a rising currency value. Why? Because if it has a low inflation, then the purchasing power of their currency will increase relative to other currencies, of course. So that's why countries that have high inflation their currency have less purchasing power. Many countries in Africa have that problem because of high inflation due to the kind of economic policies that the government have been implementing over the years. So causes led to inflation. Countries like Nigeria, Kenya, and Zimbabwe, have that problem. So that will cause the value of the currency to the purchasing power to decline. Also lowers the exchange rate. Now, during the last half of the 20th century, the countries with low inflation include Japan, Germany, and Switzerland, while the US and Canada achieved low inflation only later. Now those countries with high inflation typically have depreciated currencies. Now, another factor is interest rate. Very, very important. Those who trade currencies should pay attention to this. Interest rates are particular concern to investors seeking balance between years. Yes, is year return and of course safety of funds. So when the country raises interest rates, now in the past week, the United States have been raising in their interest rate, trying to curb inflation. That caused the US dollar to keep appreciating almost every week versus the other currencies. You know, so when interest rate goes up, so does. Now, why is that? That when a country raise interest rate, like I think it was last week that the British the Britain raised their interest rate and caused the British pound to also appreciate. The European Union, of course, due to this inflation, that most of them are targeting only a 2% inflation, but now inflation is much higher than that. US inflation alone is almost 8%. So that to fight inflation, they raise interest rates. To raise interest rate means that it costs more to borrow money, and that the demand for borrowing goes down. When the demand for borrowing goes down, people will any project that they want to do, that they want to borrow money to do the project, whether it's people or business, they will now postpone it because of the fact that the rate of cost of borrowing is high. So that means less demand for currency in the long run, and that can bring inflation down. Yeah. Now, but when the country raises interest rate, the currency will appreciate. Why? Why? Well, when the interest rate goes up, so does the yield for assets that are denominated in that currency. So as assets like that can be like currency itself, stocks, bonds, treasury. So the value, the cost without, the yield on those assets will go up. So that means that causes the value people to start demanding that currency, causing it, that making it to rise in value. So this, in other words, like I said, when the interest rate goes up for a particular currency, let's say the US dollar, for example, so then the yield for assets that are denominated in that currency, will go up. Now, when this happens, there will be increased demand by private investors, and that causes the currency to go up. Okay. So if interest rates go down, the reverse is the case. Now, another factor is trade balance. Now, a country's trade balance means the total value of its exports minus the total value of its imports. So now, when the trade balance is positive, we say that the country has surplus, or we say that it has a favorable balance of trade. Now, if it is negative, we say that the country is facing a deficit, is incurring deficits or unfavorable balance of trade. So the trade balance impacts supply and demand for currency. So why? Now, if a country with a high demand for its goods and services, let's say that country the country is importing more, is exporting more goods. That means selling more goods than it is buying. It means that there's a high demand for what the country make. And to pay for those goods and services, their customers have to change their currency to the country's currency. That will cause their currency to appreciate. So what am I saying here? That the country with a high demand of its goods and services tend to export more than it imports. So now, when it exports more than it imports, it increases the demand for its currency. So naturally, when a country has trade surplus, that means that it is exporting more than it's importing. Then the demand for its currency will increase, causing that country to have a strong currency, which means that the exchange rate will be higher. Okay. Now, if the country is facing deficit, that means it is importing more than it is exporting. It means that there's less demand for what they have. That should cause the currency value to go down because they are selling less than they are buying, which means that the demand for what they produce is less. That means it's going to be less demand, less pressure on the currency. Okay. Now, but there's always an exception to some rules like this. The United States is a good exception because US have been running trade deficit for many years. Yet the US dollar is very strong. Why? So that will lead us to what I call the American exceptionalism. So United States dollar is strong despite their trade deficits. As like I mentioned a few minutes ago, the US has been running consistent trade deficit since 1976. I'm going to show you some information I have. Well, this is the current one, though. You can see that the trade, US trade in goods with the world, seasonally adjusted. You can see the trade balance they have. So all deficits. Okay. Even 1976 that I mentioned, I don't know if they have 1976 here. But even when you look at the 2014, you can see that they are all deficits. See? Sorry, 2004, 2000, they're all deficits. 2 years have been running deficits all these years. Yet, the US dollar is strong. Why? Okay. Before that, I'm going to before I explain this, I'm going to explain, break down what deficit and surplus is. Now, so we see that because US is running trade, I'm going to use this section. US is running trade deficit. That means export minus import is negative for US. Okay, negative. So that means that when there's less demand for US currency, there should be less demand for US currency because outsiders are buying less of a US good. The US is buying more, but it isn't the case. As a matter of fact, there's even higher demand for US currency. Why? The problem is this. I mean, the reason is this. Despite the fact that for decades, US have been running trade deficits, especially with China. As a matter of fact, by far the largest by the year 2018, the United States ran a 419 billion deficit with China. Okay, so now why is the dollar still strong? Okay, now the reason is this: because the demand for dollar is usually high because it is the world reserve currency. That's reserve currency status. Now, what do I mean by that? A reserve currency is a large amount of currency held by central banks and major financial institutions all over the world to use for international transactions. So US dollar is held in large quantity in different central banks all over the world for different transactions. So the dollar's reserve currency status makes it lead to a demand for dollar-denominated assets and things like U.S. bond, treasury, U.S. certificate of treasury bills, all the assets that are denominated in dollar are in high demand because, like I explained in my previous lectures, the United States had never defaulted in their debt, and there's asset can be secured in US. Is one of the safest place to make investment. As a matter of fact, the safest. So the assets that are denominated in dollars are in very high demand. So that's bringing the demand for US currency due to that reserve currency status. So those countries that we buy from, they sell to us, pay them dollar. Then they turn around and buy our assets, buy the assets that are like bond, stocks, and that are denominated in US dollar. So as a result of that, your dollar keep on going up and up. Also, of course, other factors, of course, like interest rate. US, we expect that US will raise interest rates during the Fed meeting in the, I think, 22nd of this month, I believe. Okay. So at this point, I believe that we have covered the, everything we need to cover tonight, and I hope you enjoy the lecture. Thank you for listening, and I will see you in my next lecture. Good night.